Index investing or passive investing has grown more popular with investors. Even Warren Buffett touts the benefits of owning an entire index like the S&P 500 over the long term. An example of an index tracking ETF is BMO's S&P 500 Index ETF. It's the largest ETF in Canada that tracks this well-recognized and popular index. It provides exposure to the returns of the market cap weighted S&P 500 index at a low cost with a management fee of just 0.08%. This broad market ETF makes for an efficient building block in a portfolio, saving you time and effort while mitigating single stock risk. If you're looking for exposure to the largest and most liquid public companies in the United States, this ETF delivers an easy-to-use solution and instant diversification. Commissions and management fees and expenses all may be associated with investments in exchange-traded funds. Please read the ETF facts or prospectus of the BMO ETFs before investing. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to Loonie Hour, episode 120. As always, joined by the three amigos, Keith Dicker, Ice Cap Asset Management, brand new Patagucci Vest, and Rich Diaz, PGM Global. Welcome back to the show, gentlemen. Boomer.
Hey, guys. Hey, I'm in the football themed 2 games left for the season. I'm excited for this weekend. That's all I have to tell you.
Man, your team really was cutting it close there last week.
Yeah, I know. But like I say, at the end of 60 minutes, usually the better team wins. And there are no style points, in football, not like basketball, I guess. But, so like in the football world, if you don't know the football, this is the semifinal weekend. Think of it that way. But they actually call it the championship weekend for a different reason. But this is the most stressful weekend. Because if you win this one, then you're in the Super Bowl. The Super Bowl has its own stress, but this is the big one. So it's funny, every 49er fan, they're all cheering for the 49ers, and every other human on the planet are cheering for the Detroit Lions this weekend. They're the feel-good team. So we'll see.
We'll see how it goes. No predictions. You're going to jinx it.
Oh, well, I'll do a prediction. Absolutely.
No, every time you make a prediction, they lose.
Yeah, but that doesn't matter. I have no
highly correlated.
Here it comes. Are you ready?
Correlation equals causation, everybody. Don't forget.
That's a good point. Magic 8 Ball says San Francisco 37, Detroit 16.
Oh, wow.
You jinxed it.
Blowout. No.
I'm cheering for the Detroit Lions. I always cheer for the teams, the long-suffering fans. I just something about a group of people who spend all kinds of money and time cheering for losers. That's just that really appeals to me. So I'm definitely cheering for the Detroit Lions.
Rich, I got something different for you.
Tell me.
What do you call a fish that's missing an eye?
I don't know. What do you call a fish that's missing an eye? What?
Do you get it, Steve?
No, I don't get it at all. Waiting for you to drop the joke.
Jesus.
F-I-S-H. The I is gone. It's just F.
Oh my God.
S-H.
That is
Jesus.
the worst. Okay, let's.
Okay, well, we've got an important interview today with Tian Yang of Variant Perception. He is the CEO of Variant Perception. Variant Perception is a macroeconomic research group that caters to hedge funds, banks, and family offices. You might have heard Tian before. He's been on a whole bunch of, macroeconomic podcasts and shows, and I've been following their work for years and years. So we're excited to have him on. He's going to come and chat about what's going on in Canada, what their models are showing them, how that compares to the U.S. and around the world, and really their outlook for this country. Because we've got a lot going on. We've had the Bank of Canada rate announcement meeting. They obviously held rates, so we'll get into some of the feedback there. We've got some bankruptcy numbers, U.S. GDP data that came out, ECB announcement. So we're going to get through all of that. But we also had some interesting news on topics that the Loonie Hour has been following quite closely over the last couple of years since we really started this podcast. And Rich, we had The federal government came out first and foremost and announced caps on foreign students. So for those paying attention, again, Canada's population growing by over 1 million people a year for the last 2 years, and the bulk of that being non-permanent residents, aka foreign students, because there's no cap, there's no limit on that. And so basically, we've just been funneling millions of people into this country
Oh boy.
at these hokey colleges that are operated out of strip malls above burger joints,
If only.
and getting these fake diplomas that are really quite useless,
Yeah.
and exacerbating a housing crisis and putting strain on our public infrastructure.
Yeah. So should we give them credit for finally, after immense pressure from basically everywhere, including the Bank of Canada, which we'll get to in a minute, finally adjusting their, so what do they do? They're capping it at 35% lower? I think-
Yeah, so there's they basically capped it at 35%
Okay.
lower than existing targets. Again, I
Right.
don't know. I'm not, an immigration expert by any stretch of the imagination, but essentially that's what they did. And so what that means basically is that it's so they're giving, it's a decrease of 35% from 2023. So the cap is expected to be set at 360,000 permits. And so based on that, the cap space will be allocated by province based on population. So the cap's going to mean that some provinces can increase the number that they have, while others, such as Ontario, will have to cut intake by roughly 50%.
Yeah. Okay.
Same with Nova Scotia as well. I mean, we have a pretty good university factory
So
down this
if
way.
if you're a landlord with a basement suite in Brampton, Ontario, you might have a problem.
So do we give them credit, or do we make fun of them, or both? What's going on here?
I mean, I guess they
Well,
finally figured it out.
Yeah, it is what it is, right? Eventually the conspiracy theory turns out it's not a conspiracy theory. It's actually true. But yeah, I mean, I know it's like you were joking about, the colleges above the burger joints and stuff like that. But a lot of the bigger universities are affected as well. And that's something that we've also been talking about. The operating budgets for a lot of universities, they're already running at a 30 to 60% deficit for a lot of them. And then they had to shift from in-province students to out of province, and then, out of country. But I read a really good article this week. I forget which paper it was from.
The Hub. I think it was on the Hub.
Yeah. Did I share that with you guys? I think
You did.
I may have. Yeah. And but it went through like specifically, I won't mention the universities that were in there. You can find it for yourself. But some of them are just going to be mullered coming up with tuition, because they're getting hit by this, and there's a lot of implications with it. So we'll have to see, whether you give the government credit or not for doing it. You can never go back in time to fix things, and maybe this is the right way to fix it, or who knows. But it is something that we've been talking about for a while, and I'm sure this is a plug for the Loonie Hour. Of course, here we are, Thursday afternoon. You're watching it on Friday, but we'll have a few more issues or factors coming up that we think are going to be pretty big as we get later on into this year as well.
Well, then,
We'll get
okay, I
into-
want to give us some credit then, because then if we can't give them any credit, I'd like to give us some credit. That's the sound of me patting myself on the back for identifying this issue that, by the way, I know we're going to talk about the BOC later, but Carolyn Rogers basically articulated almost word for word what we've discussed. And credit to her for being so strong and forthright in her commentary. And in the monetary policy report, which I don't want to front run us too badly, but there's a whole chart 3A, which we'll discuss, which also talks about population growth, rent, and inflation. So there you go, Steve.
There you go. But without further ado, let's bring on our guest for this week, Tian Yang of Variant Perception. Tian, welcome to Loonie Hour.
Yeah, thanks for having me. I hear you guys are a very big deal in Canada.
Well, we don't know about that, but we do appreciate your support there. And obviously, we're super humbled to have you on the show. A lot of respect for what you guys do over there at Variant Perception. But we, looked at some of your chart decks here before we got onto the podcast. We just had the Bank of Canada came out, held rates. Listen to the commentary from Tiff Macklem, Carolyn Rogers, kind of pushing back on the premise of rate cuts. They're kind of still talking a tough game. How are you looking at that? Do you have any sort of opinion on the rate cuts, inflation here in Canada? How is variant perception looking at the market these days?
Yeah, so one of the ways we try and model central banks is we'll build regime models that use a mix of hard economic data as well as market data. And so, if you want to get geeky, essentially we're like training lasso regime models, but effectively you end up with a probability for the likelihood the central bank should be hiking or cutting. Now, obviously, with all models, it's only as good as the input. So, effectively what the model is telling you is that historically, when we've had the current combination of economic data in Canada, as well as the current kind of price action in Canadian assets, historically, the central bank has been cutting. So we'll generally have a bias that they should be cutting. The second kind of follow-up to that is, okay, but how much of it is priced in, right? Because ultimately there's one thing on trying to guess what will happen, but you kind of have to play the game a little bit. And I think the real reason why the pushbacks, led to a little bit of price action is a lot has been priced in. If we go back to even Q4, right? Obviously, we've seen kind of 2 years have come all the way off. We actually had a bunch of trading models go off to go long Canadian fixed income back in September, which actually are quite nice. Whereas I feel like right now, a lot of these things are getting quite stretched. So, long story short, I do think they should be cutting, but quite a lot's been priced in. So you kind of have to, let the market price a bit out before you kind of bet on it again. That's probably high level how I would kind of characterize it.
So right now then, realtors and more variable rate mortgage owners in Canada are you've become their next best friend, it seems like, by saying that.
Yeah, well, I think it's probably not that unreasonable, right? If you look around the world, most central banks are probably in that easing mode. Obviously, I live here in the UK, like the Canadians, we don't get the benefit of kind of, the Fannie Mae, Freddie Mac, get 30-year mortgages, right? Or we're also on the 2-year, 5-year kind of fix here. So yeah, we're all kind of in the same boat, looking for a bit of relief.
How about talk a little bit about because it seems like we've had so much volatility across all financial markets over the last I'd call it 4 or 5 years now. I'm starting to lose track, but just focused on central bank policy, reality versus fantasy, and where they come again next. Because I think I would argue all the Western central banks have become synchronized, and they all went from 0 to 5 or heading back down somewhat. How unusual is this? And can your models recalibrate fast enough to capture these swings? And like again, probably put some color on that for our listeners as well.
Yeah, well, actually, on our models, we're actually starting to see quite a lot of divergence. To your point, obviously, when you get these, historical biblical events like COVID and stuff, it's not surprising it's going to all synchronize. But actually, right now, what we're seeing is Canada, within G10 at least, Canada most needs to cut, and then the US, ECB needs to cut. But actually, in the UK, in Australia, it should actually still be pretty hawkish. So we are actually starting to see these divergences play out. And I think it's actually creating a lot of opportunities in the kind of, stir short-term interest rate kind of market. So actually, to your point, it has been synchronized coming in. Everything has traded together, all the curves steepen, flatten together. But actually, the outlooks are starting to diverge. And I think it's ultimately linked a bit to, essentially the structure of the labor force, right? Like how tight do those labor markets get? How much of a skill mismatch is there, and how much fiscal has been going in, and it's actually pretty divergent. So it's actually starting to be quite interesting again.
How are you looking at? Go ahead, Reg.
No, I was just gonna. I have the different view, and hopefully we don't get too down this rabbit hole as far as having this discussion. But I'm of the view that Canada can't cut. One of the things that Tiff Macklem said was
breadth
and the persistence of inflation was an issue for them. He highlighted that more than 50% of the CPI basket is actually growing faster than 3%. And he also articulated that the deficit spending, although not as inflationary as it had been over the last couple of years, is still inflationary. Add that to the strong population growth. So I'm just curious about sort of where, sort of outside of those sort of little items, why are you so sure, or why do you think that Canada should cut? And yeah, so maybe you just articulate that.
Yeah, so I think there's quite a lot of kind of stress we see in some of the hard growth data linked things. So small business delinquencies have picked up quite a lot. Building permits have drawn down quite a lot from peak levels. Real M1's drawn down quite a lot from peak levels. So there's some hints that growth, is kind of got, pretty decent headwinds coming. On the inflation front, I think it's actually a valid point you made, because again, we need to differentiate time horizons, right? There's one thing which is kind of structurally what is kind of inflation going to go versus cyclically. So I think it's more that cyclically on our models in terms of lead lags, the deflation or disinflation rather trend can likely continue. But ultimately that equilibrium level of ultimately where it ends up probably is a bit higher, right? To your point, there's other things we look at on Canada in terms of like youth unemployment. Canada's kind of employment to working age population ratio is actually quite high compared to, say, the US. So actually, if you want to talk about, again, I don't know how geeky you want to go, if you want to talk about R star and real neutral rates and stuff, in Canada, the models say it's quite high, actually, right, due to a lot of structural factors. But I think it's more, if we're talking next kind of 6-9 months, we're probably more prioritizing the cyclical aspects, the kind of risks around growth, the risks around if you just hold on a bit longer, that it's likely to be a bit more vulnerable. I guess the one thing is with the US and the kind of Godot's recession and how resilient it's been, they've been running massive fiscal deficits, right? So that's been like the spanner in the works. That's really preventing a lot of these leading dynamics kicking in. In Canada, it's obviously a lot less kind of fiscal stimulus, the impulse kind of neutral-ish. So without that element, is our view would be that it's more likely you get kind of a more cyclical growth inflation downturn. But ultimately you still got to kind of profit from it, right? And in fact, I'm a little bit of the view that we went a bit too far. We need this to reset a little bit to kind of put kind of the long bond kind of trade back on.
With when it comes to sort of the whole a geek fest or whatever, Rich is pretty strong in that world. I think he's undefeated. But it's kind of interesting because we seem to we talk about monetary policy all the time with the Bank of Canada and what the Americans and the Brits are doing and stuff like that. But you just brought up a really good point in that I don't think we give it enough attention sometimes. But it is the fiscal side that's really, in some ways, it is, especially I think with the Americans especially, it is overwhelming the targeted monetary impact from the central bank. And I think that's something we have to think about quite a bit as well. Steve, I think you had something there lined up as well, right?
Yeah, just based on your models in terms of like leading indicators, one of the ones that you typically tend to look at is building permits, correct?
Yes.
Can you walk us through that just for the audience that says, well, why do you look at building permits?
So the way we think about the economy is it's generally very, very hard to forecast levels and magnitude, right? Things are always changing. It's very hard to fit a regression. It's by definition always going to be wrong. But if you think about it from a more first principles point of view, the sequencing in which certain things happen in the economy have to happen in a certain sequence. So time only flows forward, right? So you can't build you're not going to build something unless you get a permit. So by definition, if you see like a big move in building permits, it's fairly likely that construction activities are going to pick up. Presumably, if you build a bunch of residential, then eventually people are going to move in. They bought a new house, they feel good. They're going to buy white goods, buy a new fridge, buy whatever Zoom new Roomba is. So I think we're generally looking for a lot of these sequencing kind of things that if you see it, then it's more likely that there's a turning point coming in kind of the coincident data that's kind of follows. But obviously it's not foolproof. But the idea is to track a bunch of these, right? So obviously within housing, you have building permits, right? Building permits actually lack kind of like interest rate conditions, right? So it's more like you're tracking, okay, what's credit conditions, what's financing conditions, home builder sentiment, and then it shows up in building permits and it shows up in construction. So it's generally like sequencing that. hopefully helps you narrow down the window in which a turn might be coming.
Yeah, no, I think that's a good point. I know you guys have in your charts there, you've highlighted, national building permits. And if you kind of unpack that a little bit further, like locally here, is you're seeing developers pull back quite aggressively. And in fact, you see it more so on builders that are building single family homes as opposed to like condo buildings. Reason for those, they're more nimble and so they can pivot quicker. And so if you look at building permits in BC and Ontario, which are your two sort of frothiest housing markets, single family building permits are running at like 30-year lows. And so, yeah, I think that's a interesting point. And ultimately, do you see that sort of filtering through into CPI? And does that play into some of your case for the Bank of Canada to ease?
Yeah, well, like I say, on the leading relationships in inflation, mostly it does seem to be lower. The Bank of Canada have their own kind of various surveys on business outlooks, on price outlooks. We look at some of the kind of CFIB surveys on kind of price intention, wage intention. So most of those are obviously more diffusion type indices than outright, but at least they give you like the directional kind of trend.
What did you say? Did you say diffusion?
Wait, did we hear like the buzzword? Or?
That's right. That's a bingo. You now I'm all hot and bothered. Anyway, sorry. Keep going.
Diffusion
Geek
indexes.
fight. Geek fight.
Actually, one thing I wanted to ask you guys about is, obviously you mentioned, especially Vancouver, British Columbia, obviously the China factor historically has been like a big driver, in the good old days. I'm actually curious, given what's going on in China, like how much impact has that been having?
Yeah, no, that's a really good question. So my proxy for foreign capital coming into this market is I always look at how pre-sale activity is doing for high-rise luxury condos. So when a developer markets, a new 50-story high-rise coming into downtown Vancouver, those are so expensive. They're all luxury buildings now. Like they'll sell them at $2,500 a square foot. Jesus, it's really expensive, right? And so the market that they need in order to absorb that is they'll typically have to go offshore. And we haven't seen any of those projects really launch successfully in like 5 years. So I'm still not seeing that market rebound. And so I'm kind of curious to segue into your views on China.
Yeah.
How are you looking at things right now?
Yeah, well, I think we're probably a little bit at the point where, well, we're definitely at the point where all Western investors probably realize a lot of China's kind of things are like a feature and not a bug in the current environment, right? I think it's taken a bit of time to adjust to kind of the new normal in China in terms of the direction of politics, what is considered important for kind of national rejuvenation. So, those things are different. Obviously, this week, you're starting to see kind of more hype around stimulus and so forth. My personal view is I think there needs to be a more kind of declarative sense from the leadership that they really do care about economic growth. They care about entrepreneurship, and that, a lot of the anti-corruption and things are just that, it's anti-corruption, but that, they still want kind of the kind of rising living standards fueled by essentially, a capitalist kind of engine, right? And the challenge has been that if we veer too far off and you start impacting animal spirits, entrepreneurs, private entrepreneurs, that becomes quite challenging. So I think that we probably haven't really seen the sign yet. I think mostly it seems to be a lot more kind of SOE government led. Sorry, Richard. Yeah,
Sorry. I was more for the other guys. But just quickly, so you deal with mostly institutional investors? I would say those are mostly your clients.
Yes.
We're seeing Chinese equity markets let's just say as a value on a valuation metric. Maybe this is a bit simplistic, but like on a forward PE ratio, flirt with single digits. Do you think that institutional investors are making a mistake given the strength in earnings that you're seeing from whether it's the electric vehicles manufacturers, whether it's certain tech and software companies that are doing really well, or whether it's sort of electrical components and manufacturing companies? We're seeing sort of the earnings grow in some cases exponential, exponential growth numbers out of those sectors, and yet the valuations are plumbing new depths. And from I was just curious about your institutional clients. Do you think are they making a mistake? Do you think we've gone too far? Or do you think that there's just been a wholesale change of view towards China from an institutional investment perspective?
I would say most people are probably comfortable with the concept that China is a trading market, but probably people are a lot less comfortable with the concept China is an investing kind of market. In terms of low valuations, I think my perception is, Russia famously always had single-digit PEs for a very, very long time, and eventually, it never really re-rated, right? And so I think there's kind of, it's no longer as simple as investing numbers financial framework, because it's like a no-brainer, right? If you want to go valuation, it's kind of a no-brainer, but I think you're getting to the realm of return off capital rather than return on capital. What if your money gets stuck if you're onshore, right? And that things happen there. You're into the realm of probably career risk for Western investors, because if you make money in China, you probably don't get the credit, because with the benefit of hindsight, it's a no-brainer. But everybody could have bought in 2009, and 10 years later look like a hero, right? But if you invest in China and you lose it all because something happened, and you have alternative choices, right? Why you can invest in Japan, which is why you're seeing the Nikkei kind of Hong Kong divergence, right? You can invest in LATAM. There's lots of different themes. So I suspect that's probably more what's going on. I really think it's kind of incumbent on I guess everyone involved to actually dial down the rhetoric and actually show some sense of what we want to return to normality. And so far, obviously, we're probably not quite there yet. Personally, for me, structurally, everyone knows about China's obviously issues with debt. Historically, in all major debt cycles, you do need some kind of recap, right, to really kind of set the floor. So, and it's very hard to see how we get that in China, right? But usually when you come out decades of kind of over indebtedness and you have a banking recap, we know what the damage is, the credit cycle can go again. Everyone will suddenly get a lot more confident that the cycle's for real. Whereas because we just never have that reset, it's just always the sense of, it's just very, very wide, the uncertainty, right?
I think we could have a whole episode dedicated to career risk. And, so you guys all laugh because we all know what it is. But I think there's a lot of people out there that are listening that they're probably not quite sure what it means in the investment world. And for you to mention that and bring it up, I chuckled, of course. And so maybe we'll go into that a little bit deeper at some point in the future. But it is a very real thing. Use an unsophisticated word in our in our industry, and that's for sure. And as well, I think people know, valuation, close your ears, Rich.
Doesn't matter.
They're for valuations for chumps in some of these.
No, I know, but there is,
it's capital flow,
was,
right? Money going in and out.
That's your view, and that's fine. But my view is that a lot of these companies are generating incredible amounts of earnings. And if you want to be an owner of those earning streams, yes or no? And
get your money in there. Lead by example.
No. I mean, India is an interesting example. You talked about Japan being the source of where people are moving to instead of China. India has been sort of one of the main beneficiaries of that outflow from China. But anyway, this is Tian. Is there anything else that you wanted to chat about? Maybe.
Well, actually, just on that, right? Maybe when you really think about it from a portfolio construction point of view, it's kind of, if you just treat all the China stuff you buy as a core option, right? You can kind of think about your portfolio as, okay, these are my 5x upside if something goes right, but I size it correctly. And this is my kind of core, high quality, resilient compounding part of the portfolio. So yeah, we've had multiple LPPL crashes go up in China simultaneously on every Chinese asset. Obviously now it's really starting to squeeze. The back tests on most of these models generally are very good, that it might sustain for a while. But I think the mindset's got to be I think it's the same reason people own Tesla and these things, that sometimes people we get too obsessed with valuations, a joke. But yeah, is there some version of the world where Elon pulls it off because he's pulled stuff off in doing SpaceX? Yeah, right. But is it going to be like a big position for me? Probably not. But it's a call option. It's probably going to be it could be a zero, or he could do it, right? And I think maybe when thinking about portfolio, it's kind of more into that bucket of, yeah, you just have a bunch of random things like this that if it works, no one expects it.
How much are you
I have
looking
one
at?
more question.
Go
I
ahead,
want to
Keith.
jump in. Then see if you can clue it up. Then, when you're, so you're based in London, you're in the UK, correct? Yeah.
Yeah.
Why don't you share with our listeners, like in your conversations, without you initiating the conversation, how often does Canada come up? Like, how big is Canada on the investment stage or economic world? Just so that our listeners can sort of, frame it from their mind.
I gotta be
Without
very
laughing.
careful what
No
I say
laughing.
here.
That's not fair.
Well, obviously, because we work in finance, you'll naturally interact with kind of the Canadian pensions, right? They've been very proactive in setting up offices and stuff. So that would be kind of a reason I would interact with it. Obviously, here the big sport is obviously, football, right? And like cricket and rugby, and like it's not that linked to Canada. I mean, when the Queen goes visit back in the day, it might be in the news, but it probably doesn't naturally come up too much. I do notice getting pushed a lot of these WestJet adverts, though, but I don't know how much that's like that's the case for everyone else. But yeah.
So what you're saying is nobody in the investment space really looks at Canada.
Well, I mean, it's probably not the first question people ask, but I would say when you say for like global macro traders or people who do it, if you bring up, people are definitely interested. But obviously by default, we're all forced to think about US, China, Europe, and then you have to, and then obviously, yeah, it's just the way it goes, isn't it?
Well, let's pull on that thread.
Get him, Steve. Get him.
No, I want to pull on that thread a little bit more. It's like one of the, earlier in the show here, you mentioned that, your models are suggesting the Bank of Canada should be one of the front runners in terms of easing policy. One of the feedback that we get quite often is, from our listeners, they say, well, how can the Bank of Canada ease if the U.S. economy is still strong? The Fed is not going to ease nearly as much. The Canadian dollar could just go to hell in a handbasket. Do you have any concerns there? And then obviously, hey, the Canadian dollar weakens, that then reignites another potential secondary wave of inflation. How do you kind of look at that from a currency perspective?
Yeah, so currencies are kind of one of the hardest markets to model that we found. So, and I think it's just getting harder now because there's a lot more factors than before, right? I think before you could get away with valuation, RER, carry, and like it does most of the job for you. These days, because of the role of fiscal, because of like shifting capital cycles, it becomes a bit harder. So we will also run kind of machine learned models, but essentially where we enforce kind of conditions on kind of current account, fiscal deficit, carry, valuation and so forth. And basically right now in Canada is actually a bit more neutral. Like one of the interesting things in the FX world is, again, I'll keep the geek factor to a medium level, but I think this could be quite interesting. So like, in economics, when you go to school, you study kind of these Mundell-Fleming models on the economy, right? And it's and essentially it can lead to a lot of very contrarian setups in currencies. So sometimes if you run a big fiscal deficit alongside a current account deficit but tight monetary policy, the currency can actually strengthen. Even though when people look at it like, oh, you run a deficit, oh, the government spending all this money, it's bad, it's going to cause inflation. And so that's one of the implications that spits out from kind of the Mundell-Fleming. And this was actually made very famous by Druckenmiller and Soros back in the day when Druckenmiller adopted this playbook when he went along the Deutschmark after reunification. So, these are a lot of the dynamics that we're trying to capture in these models. And it kind of hasn't mattered because nobody's been running massive fiscal for ages, right? But now that you have the fiscal, these things actually starting to kick back in. So in Canada, it's actually fairly neutral right now, despite all the concerns there. Whereas like, I live in the UK, the most contrarian thing is actually pound. And the pound's been unreal resilient, even though we got like a pretty, fairly recessionary setup, it looks like. So there's a lot of these funny dynamics, I think that's really messing up kind of the longer term FX kind of strategy right now.
Sorry to interrupt the show. I just want to let you know this episode is sponsored by Addy. Addy is the largest real estate crowdfunding platform in Canada. Invest in real estate for as little as $1. Addy just dropped their 39th property on the platform. It's a property in Calgary, a rental project site. If you're interested in Addy, you can get more details at addyinvest.ca. That's addyinvest.ca.
How are you looking at bond yields over the next over the medium term here?
Yeah, this is where it's really hard, right? Because again, time horizon matters. Going back to our inflation discussion, because yeah, in the kind of cyclical 6-9 months, yeah, if growth slows, inflation slows, right, and everyone's bonds have sucked for basically 3 years, then it could keep going, you could keep rallying. But then structurally, there's lots of reasons to think that the kind of equilibrium yield for where 10-year and these things should be is a lot higher, right? We live in a world of a lot more coordinated fiscal monetary policy, right? With clearly, with the US president, right? It's going to be okay for everyone to spend a bunch of money when they feel like it. Demographic shifts on our models at least actually suggest yields should be going higher, which I think that's fairly controversial because people have different models. But the way we think about demographics is we think about the pool of savers versus the pool of consumers globally, but we GDP weighted. Right. So because obviously everyone talks about obviously there's a lot of young people in Africa, but it kind of doesn't actually drive the pool of kind of savings and consumers. So on that, it's a pretty unambiguous, we're running out of savers. There's a bunch of people consuming. So the price for the yield on savings needs to go up. So
yeah, I agree with you, by the way. I'm happy you mentioned that. So it's good. You're in good company. Sorry, keep going.
Perfect. We agree on something.
We agree on a lot. We agree on a lot.
Yeah.
I think that's demographic shift sort of away from just not having enough warm bodies basically in seats. I think, and that drawing down of people's savings as they age, I think is something that the bond market has not at all reckoned with. But just please don't give Justin Trudeau any ideas as far as more deficit spending.
It probably doesn't need us to give him any ideas, right? Okay. If your neighbors to the south imagine they just carry on the last year's pace. If you end up with 2 years back to back, 7% plus GDP deficit outside of a war, outside of a recession, just everyone's going to get ideas.
What do you think about Europe? I mean, we talked about the UK, we talked a little bit about China. Your view on the US, I think we need to circle back on that because I'm really curious. But just for Europe and maybe just Germany in general, if you have any thoughts on that, maybe that some of our Canadian listeners might be interested in hearing.
Yeah, so I think Europe has behaved in line with leading indicators, both European inflation and growth. Basically the story of last year was leading indicators for growth broke for the US, right? That's the whole story. But actually in a lot of other places, it broadly worked quite well. So what you're seeing is leading indicators were terrible. Inflation is going to go down. Now it's coming through in the data. And actually leading indicators starting to bottom. So you just as the headlines and everything's coming out on kind of, hitting recession, Germany's doing terrible. So it could actually, I would say we're at that kind of just about turn, but it's not too vigorous a turn. But typically for clues on Europe, we'll follow economies like Sweden. So there's a lot of these small open economies exposed to the global industrial cycle, that actually give you more of a clue. And so, if Swedish data keeps, Swedish leading data starting to improve. So if that follows through, that's a clue that maybe Eurozone as a whole will get start to do better, right? This is a bit like when people look at South Korea to get a sense of China and Asia.
Well, that's the thing about South Korea is Taiwan and South Korean exports are actually doing really, really well, which I think has caught some people off guard. I mean, is that just a function of the U.S. deficit spending? Does that give hope for countries like Germany that are sort of geared to those other economies, or is that are they sort of bifurcating, going different directions, or?
Yeah, to be honest, I haven't looked too deeply at Taiwan, South Korea, but I assume given how hot semis are, that's probably supporting them somewhat. But I'm not actually too sure. But to your point, this is something I did look at in preparation for this. So historically, there's a very good relationship between South Korean exports and Canadian exports. Because obviously historically, actually South Korea leads Canadian exports, unreal good relationship. But it kind of makes sense historically because obviously South Korea is a bit closer. You get a sense of what's happening with China and then it follows through. That's obviously starting to diverge. So this is the interest, little bit to your question, how much of South Korea is a structural thing versus a sign that the global economy, the trade cycle is coming back. I don't know, right? But my suspicion is like, yeah, like it's probably the truth somewhere in between. We probably aren't seeing that big a global cycle coming back. Usually when yields go up, it takes a bit of time for the lagged effects to feed through. So it'd be slightly strange if we get these yield hikes, nothing happens, and then we go back to just growing again.
So as a whole, have you, or variant perception, have you been surprised with the resiliency of the economy, particularly, let's say, in the US? I think everybody coming into 2023 was the year of the recession, and it seemingly hasn't come to pass. Today we got US GDP numbers, far exceeding expectations. So growth remains quite resilient. Have you been surprised?
Yeah, for sure. So, if we rewind the clock, I think beginning of 2023, we saw it be a recession. With SVB kicking in, it started to look like it. And then by Q2, we realized something was wrong, right? By Q2, we realized clearly none of these models are working because the labor market isn't breaking. So we ended up doing a bunch of work, and we ended up kind of writing the report, which obviously I think you're aware of, like this idea of Godot's recession, right? That's what we termed it. But essentially, it's this idea that in a high inflation environment, there tends to be a lot of money illusion. But at the same time, because of the fact we have very strong labor hoarding in the US and the fiscal stimulus, you kind of supercharge a lot of these dynamics that you've seen in historical kind of high inflation environments. So the kind of TLDR of this is that a strong labor market is somewhat a feature and not a bug. So because of the prevalence of labor hoarding, companies are no longer as eager to lay off workers because it's so hard to replace them. So you're generally cutting all other costs first, and you're going to have to be forced into layoffs rather than doing it preemptively. So if you look at the pattern of layoffs, it's only happening in the kind of capital abundant sectors with all the fat to cut, right? So if you're a big tech company, you came in with massively bloated balance sheet anyway, but you're such a quality business, you don't have problems cutting people, improving margins. We've all been studying computer science for 20 years. You don't have problems finding a worker. But everyone who's been studying geology, who's been studying, who do the industrial companies, manufacturing companies hire, right? Like in a lot of other sectors, labor hoarding is a real phenomenon, and so that's kind of helping keep the labor market very tight. So then the sequencing becomes, once things slow down, you need to see kind of more pressure on profit margins, which will then eventually force a very sudden spike in layoffs if it gets too painful.
We're seeing resilience in profit margins, though, wouldn't you say?
Yeah. So that's why. So then, in which case, this kind of thing probably carries on, right? So to the profit margin point, though, again, I really didn't want to get too geeky on it, but
no, go for it. We're having a good time.
The Kalecki levy. I'm gonna throw that out there, right? So one of the Kalecki levy is a accounting identity for defining private sector profit margins, and basically it says private sector profits is the result of dis-saving by governments and households, right? That's basically it. So when you have governments spending a bunch and creating a big deficit, that actually in the accounting ends up propping up profit margins. Yeah. So you've had households draw down savings and the government spending a lot, and that's what props up profit margins. Now the question is, can that continue? So obviously, in the US, I think even the deficit was probably more generous than they intended, right? Because they didn't bother closing any of the loopholes, and then they handed out a bunch of like green tax credits. So like, so even though the CBO or whoever thinks you're running like, a smaller, it keeps telling you they're going to run a smaller deficit, but the numbers keep not adding up, right? So, it's possible we get a repeat, in which case that is mechanically the profit margin that carries on. But if the fiscal fades, then this might kick in.
And what's your base case here for 2024? What's variant perception's current view or outlook for the year? Mild recession? Is it the magical soft landing?
So I think I'm still quite skeptical on the soft landing, but I actually think it's a very interesting environment to have the markets giving you an opportunity to benefit from both kind of extremes, right? So scenario one is we carry on with fiscal, it's an election year, right? Enables labor hoarding, et cetera, to continue, in which case inflation is underpriced because nobody's pricing inflation to go up. So, to the extent there's gold, tips, energy, Like there's tons of inflation assets that could benefit a lot that don't have a lot priced in, right? Equally, industrial commodities, a lot of EM, like there's a bunch of things that can benefit in an inflation scenario that's been beaten up last year. So you can have that piece. The second piece is the Godot's recession kicks in, these things start to run out. The excess savings start to be run down, the excess surplus earnings that kept companies going start to run out, and then the layoffs pick up, then you end up with more of a hard landing kind of scenario, right? So in that kind of scenario, again, if you look at like how a lot of defensive sectors, staples, a lot of these equity markets, they've really underperformed last year. So they typically tend to be more beneficiaries. So you can have kind of that bucket as well. There's a lot of bad news priced in there. So and then obviously in both legs, the dollar actually could do quite well, right? It's only in the middle leg, the dollar does poorly. So that's kind of more how I'm trying to think about it in that. Yeah, after last year, I don't think my mentality is a little bit stick to the areas where lead indicators did work, stick to a lot of investment trade ideas around that. Here, we know that there's a divergence. We likely know the drivers, but we don't know when it runs out, right? Like, and I've seen, there's a lot of smart people making comments on in the US state level, budgets have not been spent, right? There's all these things they need to spend, and that could be a boost, right? There's tons of these things that it's just very hard to actually quantify. So I think for me, what I'm watching very closely is kind of this labor hoarding phenomena, which we proxy by looking at kind of hiring intentions versus kind of profits. There's a bunch of surveys from the NFIB and so forth and you can see the gap. So I'm kind of really focused on that to get a sense of which way it breaks.
So can I ask one more question on the labor hoarding? Sorry, I know we're dragging on here, but one of the indicators that I've noticed recently is people working multiple jobs. Now, unfortunately for Canadians, we don't have as good a data, and this is why often we use America as the proxy. But there's one series from the Bureau of Labor Statistics that shows multiple job holders, either as a percentage of total or in the absolute number. And if I'm not mistaken, I think we just hit an all-time high for a number of people holding multiple jobs. Now, for an economy that's meant to have a really robust labor market, doesn't that give you a bit of pause?
Yeah, I mean, there's been so many under the hood signs of issues, right? This slow burn. So this goes back to, I think when we say labor hoarding, it just means the labor market deterioration is just slow burn, and then sudden, right? This is the classic Hemingway, like very, very slow and then suddenly. I think that there's so many signs, right? Like, if we think about, for example, birth death adjustments, right? That's been adding a lot of things to non-farm payrolls. There's a sense that maybe that's the issue.
Can you explain what that is quickly, just so because people don't know what that is?
Yeah. So normally in a healthy economy, new businesses are being started, right, as time goes on. Now, those new businesses are obviously not immediately in the survey sample when the feds come knocking, asking you questions. So when we model it, or when the Statistics Bureau model it, they're adding adjustments, which generally boost employment numbers. But these models work on like essentially a trailing look back period. So at the turns, they could be quite wrong, right? And so there's a bunch of these different divergences because, again, we see data on a bunch of small business bankruptcies, right? Small business create a lot of jobs. So should they be creating a lot of jobs? Yeah, like state level continuing claims, initial claims, right? There's a widespread like rise and stuff. So there's just tons of weird things in the labor market. The household survey versus kind of the BLS surveys, and like just like there's a lot of signs that something there's a lot of signs is deteriorating. It's just the pace issue, and that was a real lesson from 23. Because normally when you start to see it historically, it just immediately breaks, right? It's more of like you see those credit spread charts. When it goes. And this time around, it's just not doing it.
Yeah.
Cool. Thank you.
Yeah. And just to, as we get close to wrapping this up here, I guess going on a final question for our listeners, that are out there listening to this, there's a lot of information to digest. If you were to summarize, like what would be like one thing today that you're looking at and saying, this is keeping you up at night? Is there one thing that you're concerned about or paying the closest attention to?
Well, yeah, I think if we make it slightly more specific, it'll be helpful. I think just everything. It's like I look at so many things.
Is there anything like in markets, like, so for example, like I'll get like for myself, the one thing that keeps me up at night is that second wave of inflation, right?
Okay.
And so I'm just kind of curious, is there anything in particular in markets, like maybe it's China, having more of a deflationary impulse, some sort of
Refinancing, the credit
credit event?
refinancing.
Right. Okay. Yeah. So I think for me, the most important thing this year is gonna, which we hit on a little bit, is how fiscal evolves in the context of labor hoarding. So I think these are the two main supports that's kind of there. Going back a little bit to like the US consumer, right? Like the job market is very strong, but personal finance is not strong, right? Maybe that's why people have a lot of jobs. Like all the personal finance surveys are pretty bad. Credit card debt's picked up quite strongly. There's a ton of different things like that. So but for me anyway, I think it's just how persistent labor hoarding is and how much fiscal we get. I feel like that'll drive a lot in terms of whether we end up in that inflation story or the deflation story. But I think before that breaks, you're going to get a lot of vol and opportunities around kind of, software futures, a lot of the stir markets that keeps trying to price one or the other. But China, I probably feel a lot more relaxed this year than last year. I do think structurally it's going to be a while before you can really turn bullish on China, right? Like I say, without a recap, without like really, clearing the decks and making it clear we can have another credit cycle, it's gonna be really tough. Animal spirits are tough, but we're clearly at the point of intolerable pain, right? That they're starting to come out and really trying to shift the narrative here. So that I'm probably a bit more relaxed about. Yeah, I think it's just all eyes on the US because actually, it's not keeping me up at night, but it's probably the most uncertainty is, could this be the first time in history we have a desynchronized cycle of the US versus everybody else? So historically, the saying goes, US sneezes, everyone catches a cold, right? Because it makes sense. But this time around, the US is being resilient while everyone else kind of went through a recession already, and everyone else is kind of coming out. So you might have a desynced cycle, which could really mess up a lot of kind of traditional frameworks. And
it's because of the vaccine that protected the US.
Well, Keith, I think that's a good way to end it. Thanks a lot for that. But no, Tian, it was awesome having you on. I'm definitely would love to have you on the show again. But a wealth of information for our listeners here. So thanks so much for your time.
Yeah, thank you for having me on.
There's another good interview there with Tian. So I think we kind of went around the world, and interesting to get his different perspective. It's, it always fascinates me when a guy like that, a lot of models, a lot of research, some very, very smart people there, can get surprised by markets. I think it just shows that, markets have humbled a lot of people, I think, over the last 18 months.
I think though it also shows, we talk quite a bit about we're in this experience now of extremes in monetary policy, fiscal policy, inflation zooming and then collapsing and stuff like that. And so in some ways it's comforting to hear someone like Tian, they're saying, wow, like this was a bit unexpected. But in other ways, I think it should also prepare people that, yeah, these are extraordinary times. And, we should expect, some unexpected turns coming up.
I think like the takeaway, like the potential outcomes, like even like this year or next year, like the potential outcomes in the near term could go either direction. Right.
And it's also, we also discovered it's cool to be a geek, apparently, right?
It is.
Rich, that was your boy.
Yeah, he was great. It's fun. It's interesting to hear his perspectives for sure. I thought his take on the US was an interesting one. The labor hoarding, we'll see about that. I think companies are profit maximizing, and we'll see, if aggregate demand slows down. One thing we didn't talk about, unfortunately, was household sector and how strong they are. I mean, he mentioned that there was some weaknesses sort of in delinquency rates and credit card spending and all that. But the household, consumption just keeps ticking along in the US, sort of the opposite of Canada. So, but maybe that's maybe we can switch gears a bit. And
yeah,
I know we loads to talk about still. We don't have much time.
Yeah, Canada. You guys watched the press conference there with Tiff Macklem. It's kind of interesting. I mean, obviously they had to push back on rate cuts, which the markets are expecting. It seemed like every journalist in that room was saying, when are you cutting? When are you cutting? A lot of variable rate mortgage holders in that room. And they push back. I mean, they play a a tough game.
Yeah, I think for me it was just a couple of things that stood out. One was Carolyn Rogers basically really just putting to bed any of these claims that population growth and inflation in Canada are not linked. She wrote, any increase in the population, particularly in an environment of constrained supply, is going to put an upward pressure on prices. And she went on to talk about that. In the monetary policy report, which we haven't really discussed, I think it's on page 15, there's basically a whole section devoted to the population supporting rental prices, inflation, and sort of the knock-on effects of that. And the other thing that I thought was really interesting for me was Tiff Macklem mentioning breadth and the persistence of inflation. And he said more than 50% of the basket is going up faster than 3%. And so for me, that was two very, I thought, rather hawkish, but maybe I heard what I wanted to hear. I think that's always true in these kinds of press conferences. You basically just you interpret the things you want the way you want to interpret them. But to me, that means that there's no cuts coming. Not until you sort of get those things to change. But Keith, what did you how did you interpret it?
I mean, what caught my eye? The Bank of Canada specifically said, "Hey, demand is slowing, and growth has stalled." So that's what they said. The first half of 23, they said is going to be a bit tough, and then growth should reaccelerate in the second half. So they're calling for a soft landing, and it's always hopeful. We have that word again. That's what everybody wants to experience, and that's what they're telling us we're going to experience. But then the downside with it is that that's not what happens. And then, as you pointed out, Rich, the two big, the hockey player in the room, is that the one to say, or the curling rock or whatever, housing shelter CPI still at 7%, and food inflation's at 5%. So, those are things that may not come down too hard if we do get a bit of a hard landing in some ways. So I think it's going to be this precarious 6 months coming up. And so, we'll start to get some more data coming out soon. We saw the US data that came out this morning as well. But Steve, how about yourself? What jumped out at you with the Bank of Canada?
I mean, I don't know. Nothing. It was kind of, you can sit here and analyze all these comments, and at the end of the day, does anyone really know? I just think that, it's the Bank of Canada. I'm sure you still want to maintain relatively tight financial conditions for now. And so I don't think they're going to be like, well, we're going to start easing in March, and we're going to, so I don't think you can really expect anything different from them. I think what I will say is just anecdotally, and, it's just funny, reading Twitter today, you're starting to see all these Toronto realtors starting to post all this stuff now, but like anecdotally in Vancouver and now what you're seeing and hearing in Toronto is like, the consumer is starting to try to front run the Bank of Canada on the housing side. Everyone's reading CBC News and saying, "Oh, I heard rate cuts." So like this is just people that don't listen to the Loonie Hour. That's, I would say, how most people tend to think, is I heard this, I read this, and they take it as if it's going to happen. And so we are seeing people saying, "Oh, I heard rates are going lower. I should get into housing before it takes off again." So we are starting to see, some multiple offers coming back.
But I mean, where we are now, though, is what we talked about, I think, last week and the week before and the week before that, and and so on, is that we don't want to see rates coming down 50, 75, 100 basis points. Like that's going to be economic hell if that is happening. You really want them to pretty well stay where they are now. That means the economy is stable, when we'll get through this mess.
I think there's going to be a lot of people, though. Like I said, I think if rates settle in here, like, maybe if the new normal for Canadian mortgage rates is 5%, I think there's going to be a lot of people that are going to be disappointed. And a lot of people, still 55, close to 60% of the float that still needs to renew with a 5 in front of it. And so there will be a lot of people, I think, that will be quite disappointed and will have to adjust their lifestyle. So, yeah, the range of outcomes this year seems wide open. But yeah, I mean, Keith, you had the ECB out today. I know you follow them pretty closely. What were they saying?
They were kind of similar to the Bank of Canada with their message. and that, they were strongly suggesting that their next move would be a rate cut. And by the way, we didn't say that here, but that's what the Bank of Canada absolutely said.
Yeah.
Their next move is likely going to be a cut. We don't know when, but that's where we're leaning. And the same thing with the ECB. So, yesterday, which was Wednesday, not to be funny about it, but just to note the sequence of events here. The Canadian dollar was very weak on Wednesday relative to the US dollar. But also on Wednesday, the US dollar was extremely weak relative to everyone else as well. So on a cross basis, Canadian dollar got mullered on Wednesday. And now here this morning, it's the euro turn. The euros, they're getting hit pretty hard here this morning because of their sort of dovish monetary outlook, combined with, with the Americans. We jump into the American story next, but we had this incredible strong data coming out of the US. Rich, why don't you hit on that real quick, and then we can clue up then, Steve, with something that you wanted to finish with today as well, because the time permitted.
You mean the GDP stuff? Because that was
that absolutely.
was. I mean, the GDP stuff was okay. I mean, it was. It was much better, right? I mean, an annualized Q4 GDP, I think it was the advance, right? It's 3.3 versus a survey of 2.0. Personal consumption, again, strong, 2.8% as an annualized number, remember. What was interesting, I thought the price index continued to fall. Remember, we've talked about the implicit price deflator, which is basically just a different way of saying sort of inflation. That continued to fall. That was for me. I thought that what was more interesting is as far as the data today that came out was the durable goods orders in the US just continue to be much more resilient than I think people sort of expected. So, I mean, it's kind of a mixed bag, Keith. I don't know if that was helpful to you, but I thought it was sort of a mixed bag as far as the data.
That wasn't helpful. That wasn't helpful at all.
It feels like, to summarize, like we're kind of like agonizing all over all these data points here over the last couple of weeks, but it feels like we're kind of like in no man's land right now.
We are. That's right.
Like everyone's just trying to like feel it out and figure out where we're going to go this year.
But with the diffusion index, like not trying to be funny, yesterday, again, which was a Wednesday, the US PMI data came out from services, manufacturing and composite. And again, like the American data on the surface it's good. Like it's not bad. Right. Underneath the hood, it's pretty messy, of course. And but again, we have this odd situation that Tian sort of highlighted. The American story looks really good, but it's obviously being significantly boosted by the fiscal stimulus. And so just think of Canada. If we didn't have the fiscal stimulus or the population stimulus, then our data would look really bad, because right now we're sort of treading water with the data, and that's with these two incredible amounts of stimulus factors piping in. But Steve, one more minute and you got to jump, right?
Yeah, well, speaking of messy, to plug the Loonie Hour, things that we've been following along, it was ruled that Ottawa's use of the Emergencies Act against the convoy protests was unreasonable and violated the charter. The federal court has ruled. So Rich, Keith, I think we can chalk that up to another Loonie Hour victory here.
I'm just laughing because, oh man, I don't know. I guess all the good things come to those who wait. I mean, what are we supposed to say? I mean, we felt it was an outrage. It was an outrage at the time. It's nice to hear that the Justice Mosley came out and sort of supported that. I'd say that I'm just really disappointed that instead of just taking their lump and just moving on, that they're appealing the decision. I thought that was the most incredible takeaway from all of this. Just an inability to appreciate when mistakes are made, to adjust.
Can we just quickly unpack that for the record? So the court basically rules that, hey, you know what? It wasn't justified. The reality is even though the courts ruled that, what does it mean? Nothing really changes. Nothing happens. This is just the discovery. But so Christopher Freeland, the day of, says, okay, well, we're gonna challenge that ruling. And so you're going to spend a bunch more time and public resources, tax dollars, to fight this so you can reverse the decision for what?
And political capital. I think
that's all it is. You're just trying to save face. You're going to go spend you're going to spend all these taxpayer dollars just to say, see, we were right. We were like, it's just like, I don't know, I think that's like the most like infuriating part. So let's
Yeah,
just
me
take the
too.
lump and move on. Like,
I think we could spend a whole episode on this. I have very strong feelings about it, and just a real quick 10-second. It is absolutely horrible to cut off people from their banking because of a different view on something. Whether you agree or disagree with the government, your banking should not be cut off. That's horrible. However, it also creates this incredible opportunity for the government, for the Bank of Canada, and for everyone else to create this central bank digital currency, because then they won't have to use the Emergencies Act to cut off people's banking. They can just hit it with a switch anyway, Rich.
I mean, let's not.
CBDC, but jokes aside, and don't disconnect from that, because again, like this is where the world is going. If you disagree with people in authority and power, because what happened, like this, it literally sent chills down people's spines or
It did
backs
for me.
or whatever. Yeah, absolutely. That if you donate money to a view that you support, but that was disagreed with by government, my God, like it was pretty outrageous. And remember, the whole reason for the protest was a disagreement about the COVID policies that were in place at the time. And for some reason, governments on both sides, right? They're now getting a soft pass on this.
Yeah.
So it's again, this should be a very important conversation for Canadians. It's not, red shirt versus blue shirt or him versus her and stuff like that. That was an outrageous decision that was made at the time. Then, as you mentioned, then Steve, sort of the double down and for the government to say, "Hey, we disagree with it." That's still extremely divisive, and it creates even a bigger rift here amongst everyone.
Well, that's why I
So-
think it's important we like sort of just read what Mosley said, because he says, I have concluded that the decision to issue the proclamation does not bear the hallmarks of reasonableness, justification, transparency, and intelligibility, and was not justified in relation to the relevant factual and legal constraints that were required to be taken into consideration. That's very blunt and very direct. How do you say? Repudiation of the government's position. And I think what people don't realize is the Emergency Act is I'm not a lawyer, I'm not a legal scholar, but it is like a very heavy-handed piece of legislation. It allows basically the government to rule by decree and permit all kinds of unconstitutional behavior. And Keith mentioned cutting off people's bank accounts. And all kinds of other stuff. And the arrogance, I think, is really just kind of breathtaking, Steve. I don't know. And the unwillingness to just say, we made a mistake and we're sorry. It's just, I don't know.
so there's so the court found, contrary to the government's position, that there were, quote, no violent incidents and threats of violence across Canada, except at the Coots blockade, and that all arrests at the convoy protests up to the invocation of the emergency were for, quote, minor offenses.
But also the lying. Remember, there was the lying about the arson. There was lying about all of the racism that they used as justification. There was the lying about sort of the threats to people's lives. Was it disruptive? Of course it was freaking disruptive. That's the point of a protest. But I think, Keith, you're right. Maybe I'm not angry enough about just giving these people a sort of a pass for what was.
But don't forget, if you listen to the honking, honk, honk, if you listen close enough, it sounded like Hail Hitler. Honk, honk. That was actually used by one of the witnesses.
Come on.
She was a
I'm not
Liberal
joking.
MP.
It was absolutely there.
Yeah.
And the other thing with this, for everyone around the world, if you live in your nation's capital or your provincial capital, you should 100% be prepared that there's going to be protest in your area at some point. They might be very minor or they might be major, but that's where the protest is going to take place. And, that's a bit of a trade-off. If you're going to live in Ottawa, you should expect these things to happen. If you live in Saskatchewan, maybe not so, right, Rich?
Right.
Right.
Well, I think to summarize it on this week's episode, Loonie Hour 2, federal government 0. So I think we'll wrap it up there, and we'll make sure to check the score 12 months from now. But as always, appreciate your support, and we'll see you next week.